And I'll do a post FOMC update. I'll start with the stock market. I suspect the plunge protection team is going to try and keep the stock market propped up through the rest of the holiday buying season. But I don't think there's a whole lot of upside potential or downside potential for the rest of this month. I think we're probably just going to chop. Prices is stretched too far above this 200-day moving average for us to have a realistic shot of getting any kind of big sustained tradable move to the upside, in my opinion. But I think they're going to do everything possible to try and prevent any kind of a major correction during the holiday season. So I think the most likely outcome going forward, at least for the rest of this month, is probably just sideways chop right around these highs, and we're going to have to wait till the middle or end of next month before we get our intermediate cycle decline. We're still only 7 days into this new daily cycle. The ICL, or the cycle bottom, tends to occur. If it's a short cycle, it'll occur somewhere around day 25. If it's a normal cycle, it'll occur somewhere around day 35 to 40. And like I said, we're only on day 7. So we got a lot of time here for the market to probably chop sideways before we really start to move down with any aggressiveness, something that could be traded, if you want to trade from the short side. But I don't think there is a trade either way, long or short, in the stock market for the next 2 or 3 weeks. Moving on to the dollar. In one of my last videos, I predicted that the Fed was going to halt their rate cutting cycle, and at face value that would seem to be bullish for the dollar, but I told you it was going to fall on that news. It did, and it has broken below this intermediate cycle low. So we technically have a failed intermediate cycle in progress. It's still very, very early in this intermediate cycle. We should have 10 to 15 more weeks before this intermediate cycle bottoms. So, for all of you that have been listening to the dollar bulls that keep telling you that the dollar is going up, and have been telling you that for, since the top in 2017, they continue to be wrong. The dollar started a bear market in 2017. And really, the only thing that's kept this thing propped up is just multiple interventions by the ECB to suppress the euro against the dollar. You can see every time we tag this 200-day moving average, we'll get an intervention with a very strong push for several days, and then it fades away once the manipulation eases off. And this has just been going on for the last year, really. But this last move, they were not able to hold the dollar above the 200-day moving average. It lost it convincingly yesterday, and like I said, it broke this low. So now we are making lower highs and lower lows, and doing it on an intermediate degree scale, which means that the 3-year cycle in the dollar has topped. Now, this doesn't mean the ECB is going to give up. They will almost certainly try to turn the currencies back around, but I don't think they are going to succeed. I don't think they're going to be able to keep this up any longer. The next major intervention, we'll probably have some intervention here into this week to try and prevent the dollar from closing below this intermediate low. But the next major intervention is probably going to occur at the 200-week moving average. They'll try and hold that line. But as you can see, they've already got problems. They have not been able to get any separation away from the 200-week moving average, and the 200-week moving average has flattened out and is actually starting to roll over. So I've been right all along. We started a bear market here in 2017. The next 3-year cycle, this was a 3-year cycle low. The next 3-year cycle low is going to be doing 2021 spring or summer of 2021. So this should be the top of the 3-year cycle, and we should the dollar should generally be moving lower until sometime in 2021. The question will be whether or not the dollar comes down and breaks this last 3-year cycle, though. I think it will, because I think it has been artificially propped up for at least a year, and I think that's going to have consequences. It's going to mean that the selling pressure, once it really gets started in earnest, will be extreme and should push the dollar considerably below this before we get our next 3-year cycle low. And all of this, of course, should have implications for gold. The dollar has started the multi-month move down into its 3-year cycle low, then gold should be ready for its next intermediate rally. And you can see, zoom in here a little bit, you can see gold this morning is trying to break through the intermediate trend line. So, I'll say it again, the many analysts that keep calling for lower gold, they're, looking at things like the COT report. And I've mentioned this before, there are times where you just have to ignore the COT reports. They aren't useful. The beginning of the baby bull rally was a case. Coming out of last year's bottom right here, it was also the case. The COT reports just kept you on the sidelines and you missed the rally. And it's because the commercials are stuck in a huge short position that they're not able to get out of. They are not being able to manufacture the panic selling. That's what happened here. They tried 3 times. They ended up with a huge, gigantic short position that they never got the panic sell-off that allowed them to cover that short, so they ended up getting caught in a squeeze. That's what triggered this very aggressive and trending move higher. And the same thing is happening now. The reason the COTs are so bearish is because the commercials have been trying desperately to create a panic sell-off so they can cover that huge short position, and they just have not been able to achieve it. So now they are again stuck in a big short position, and they're at risk of getting caught in another short squeeze. I think they are going to get caught in another short squeeze, and that's why I think we're going to have another very strong trending move coming out of this intermediate bottom that'll be very similar to this one. And I think we're probably looking at a target somewhere between $1,700 and $1,800 by April or May, which would be probably the top of this intermediate rally that I think is just getting started right now. So I've been trying to call attention to this in my last several videos. Many of the miners have been acting extremely bullishly, which would not be occurring, in my opinion, if gold had serious downside risk. It's also late in the intermediate cycle. This is a very mature intermediate cycle, and I'm monitoring sentiment. And just one other sentiment clue that I kind of watch for is usually at these intermediate bottoms, I'll get a few subscribers will start canceling because they get frustrated, and that is the bell ringing. That's the dumb money traders. When I see the dumb money people, throwing in the towel and giving up their positions, canceling subscriptions, I guess we should thank them, because they are the ones that send us the signal that now's the time to buy when they are selling and canceling their subscriptions. So it looks to me like we've, as I've been saying all along, I'm pretty sure this is an intermediate bottom, and actually gold made a higher high today, so we've got a series of higher highs and higher lows in gold now, as well as the miners. So the odds are stacked pretty firmly in favor that this was a final intermediate cycle low, which means you should buy all dips for the next 3 to 4 months.